the next thing I wanted to share with you is an article that was in yesterday's Financial Times about exchange-traded funds, ETFs. And I thought this was absolutely fascinating. We talk about science and economics on this program. This is and personal finance and whatnot. And first of all, you have to know how an ETF works. If you have, and in this case, they're talking about stock index funds. So the Dow Jones Industrial Average is a list of only 30 companies. 3M, American Express, Apple, Boeing, Caterpillar, Chevron, et cetera, et cetera. It's only 30 companies. The Standard & Poor's, the S&P 500, is 500 companies. It's actually 505 companies, because 5 of the companies offer 2 different kinds of stock that are both listed as part of the S&P. But the Dow is only 30 companies. So let's just take the Dow, for example. The example works for the S&P, but it's not quite as obvious. If I started an ETF, an exchange-traded fund that is just the Dow, and I come to you and I say, put $10,000 into my fund. You put the $10,000 in, and what I do is I go out and I buy equal amounts of these 30 stocks. That all makes sense, and you kind of own them indirectly, and I charge a small fee off the top, a fraction of a percent for managing this on your behalf, and that's how ETFs work. And then when you come to me and you say, I want my money back, I want to sell my share in the ETF, I say, okay, let me sell the stocks, and here's your money back. Now, this only becomes a problem during cycles of boom and bust. And specifically what that is that when the stock market is booming and there is a bubble, people start pouring money into ETFs like there's no tomorrow. And then when the inevitable crash comes, the inevitable market correction, the ETFs have to start dumping that stock. Now, first of all, they're buying stock like there's no tomorrow because all these people are throwing money into it, which is, you're buying the ETFs, but the ETF company is buying the stocks. So what's that doing? It's driving up the price of the stocks. But secondly, when the stocks hit a certain point and they start to decline and people say, okay, it's time to bail out of the market, and I'm going to sell my QQQ or whatever it may be, I'm going to sell my exchange-traded fund on the Dow or on the S&P. At that point, they've got to sell those stocks, and selling stocks in large quantities drives the market down even faster. So it's a prescription for disaster. Now, with that understanding in mind, listen to this story. This is by Chris Flood in yesterday's Financial Times. Exchange-traded funds have attracted the biggest inflow of money in the first 2 months of the year on record. All right, this is beating out the bubble of 2007. This is beating out the bubble of 99 on record. Investors around the world plowed $131 billion into these index tracking funds in the first 2 months of 2017. This follows a record-breaking year in 2016 when ETF managers gathered more than $390 billion in new cash. And then they talk about, everybody's expecting Trump's sweeping tax cuts and large increases in infrastructure spending are going to further drive up the stock market. Well, we will see. But then they quote Nick Nelson, an equity strategist at USB. He says, we've seen a huge amount of money pour into U.S. equity ETFs since the presidential election in November, and that has contributed to a move higher in the stock market. In other words, just what I said. If you put your money into these ETFs, they have to buy the stocks. The stocks then go up because there's more demand for them. Dan Mannix, what's his first name? Chris Flood writes, Dan Mannix, the chief executive of RWC, the UK asset manager that focuses on actively picking stocks, said he feared unsophisticated investors were being, quote, suckered into the market because ETFs were cheap. There are dangers if ETF flows reverse, he said. That is a risk that the tide will turn. This is quoting this Dan Mannix guy. Much of the capital in ETFs is short-term, so we would see rapid outflows followed by a vicious circle where falls in asset prices lead to more selling pressure from ETFs. There's been an 11.6% rally for the S&P 500 since Trump was elected. It's currently trading at a historically high valuation of 18 times future earnings. Albert Edwards, a strategist at Société Générale, the French bank, said U.S. stock market valuation was totally unjustified. ETF investors could find themselves exposed to disappointment unless we see positive news on corporate tax cuts or infrastructure spending, as the earnings cycle in the U.S. equity market has now reached a more mature stage, he said. This is actually a very alarming article. And as I said, it's in today's Financial Times, something worth checking out.